The average person doesn't know what diversification is. I'll make you smarter than the average person in less than 3 minutes. Diversification is a risk management strategy that involves spreading your investments across different asset classes, sectors, and geographies in order to reduce the impact of any one investment on your portfolio. Here's an example. Let's say you've got $10,000 to invest. You could choose to invest it all in one stock, such as Apple, but this would leave you vulnerable to the risks associated with that one company. Alternatively, you could spread your investments across different stocks in different industries, such as Apple, Amazon, and Coca-Cola. By doing this, you reduce the risk of losing a large portion of your investment if one company performs poorly. Another example of diversification is investing in a mix of different asset classes, such as stocks, bonds, and real estate. By doing this, you can reduce your exposure to any one asset class and create a more balanced portfolio. A well-known commercial example of diversification is the Walt Disney Company. Disney is known for its theme parks, movies, television shows, and merchandise, but the company has also diversified its business over the years. For example, Disney has expanded into cruise lines, resorts, and sports broadcasting, and has acquired companies such as Pixar, Marvel, and Lucasfilm. By doing so, Disney has been able to spread its risks across different businesses and industries, and thus has created a more stable and resilient company. This diversification strategy has helped Disney maintain its position as a leading entertainment company, even during challenging economic times or when certain business segments are facing difficulties. Yo, before we carry on, if you're interested in learning from the trainers that teach the top 4 global investment banks, analysts, and associates, check out the first link in the video description and use the code AFSAL25 and you can get 25% off all of their courses. Now let's get back to the video. Another example is global investment banks. They've got the investment banking division, they've got the asset management division, they've got sales and trading, they've got private banking. All of these different divisions are earning revenues from different activities. So when there's a crisis or when financial markets are going through a different stage of the cycle, some of these divisions are going to be performing better than others, and in other times these divisions are going to be performing worse. And that's why investment banks are always generating revenues, because regardless of where in the economic cycle we are, there's a division that's making money even if a different division is losing revenue. Diversification is important because it helps investors manage their risk and increase the likelihood of achieving their long-term financial goals. By spreading your investments across different types of assets, you can reduce the impact of any one investment on your portfolio and potentially earn a more consistent return over time. Diversification doesn't guarantee profits or protect against losses, but it can help manage risk, which is always very important. It's often considered one of the key principles of investing, alongside others like asset allocation, cost management, and staying disciplined over the long term. Some investors choose to diversify by investing in index funds or ETFs, exchange traded funds, which provide exposure to a broad range of stocks or bonds. Diversification can be especially important for those investors who are nearing retirement or for those who have a shorter investment time horizon. The main reason for this is they are less likely to weather any large losses. Last but not least, while diversification is super important, it's also important to avoid over diversifying, which can lead to a portfolio that's too broad and too difficult to manage effectively. That was diversification explained in 3 minutes. Like the video and let me know if that made sense.